Ever wondered why CEOs always seem to fail upwards? It's a curious case, isn't it? This concept, known as failing upwards, might seem counterintuitive at first glance. After all, isn't failure supposed to lead to setbacks, not advancements? But in the corporate world, and particularly among CEOs, things take a different turn. Failing upwards is an intriguing phenomenon where individuals, despite making blunders or performing below par, ascend the career ladder instead of descending. It's as if their missteps are stepping stones, propelling them to higher positions. It's a paradox that leaves many scratching their heads. Why does this happen, you might ask? Well, the reasons are manifold and often complex, rooted deep within the structures of corporate governance, power dynamics, and sometimes sheer luck. To delve deeper, let's look at a few case studies that exemplify this intriguing pattern. And who knows, you might discover that failing upwards isn't as mysterious or as rare as it first appears. Consider the case of a certain tech giant CEO who was ousted due to a string of failed product launches. Despite a series of misfires that should have sent any career hurtling downwards, his instead took an unexpected turn skyward. But how? Let's delve into this. The CEO, despite the failures, was a visionary. His ideas might not have hit the mark every time, but they were bold, innovative, and ahead of their time. His ability to think outside the box and envision a future that others couldn't set him apart. His failures weren't seen as incompetence, but as signs of tenacity and resilience. After all, without risk, there is no innovation. Additionally, his leadership skills were highly regarded. Despite the company's shortcomings under his watch, he was able to build and maintain a strong team. He inspired loyalty among his employees, who admired his vision and dedication. His ability to rally his team, even in the face of adversity, was a testament to his leadership prowess. Moreover, his networking skills were second to none. In the world of business, it's not just about what you know, but who you know. He had cultivated relationships with key players in the industry, and these relationships proved invaluable when he was on the lookout for new opportunities. Lastly, the CEO had a proven track record of success prior to the failed launches. This history of achievement was not forgotten. The business world is forgiving of failure if it's sandwiched between successes. And in his case, the successes were significant. So, despite the apparent setback, the CEO landed a more prestigious role in another tech company. His vision, leadership, networking prowess, and past successes had all contributed to his upward move. In this new role, he was given the opportunity to apply the lessons learned from his failures and lead the company to new heights. In spite of the failures, his career trajectory moved upwards, not downwards. And this, dear listeners, is the curious case of failing upwards in the tech world. Our second case study involves an automobile industry CEO who faced a similar situation. Once upon a time, there was a CEO at the helm of a major automobile company. His tenure was characterized by a mix of ambitious projects and audacious strategies. However, despite his vision, his leadership led the company into a financial crisis. The company was bleeding money and the stock prices were plummeting. It was a classic case of a sinking ship with the captain at the helm. But here's where the story takes an interesting turn. Instead of falling from grace, this CEO was hired by a rival company. Not just in any role, but a position higher up the corporate ladder. A move that left many a jaw dropped in the business world. Now you might be wondering, why would a company hire a CEO who had just led another company into financial turmoil? Well, there are a couple of reasons behind this seemingly counterintuitive move. Firstly, this CEO, despite his recent failure, had a track record of innovation and audacity in the industry. He was known for pushing boundaries, for thinking outside the box. This was something the rival company was looking for. Secondly, the rival company believed that the CEO had learned valuable lessons from his recent failure. In business, failure is often seen as the best teacher. The thinking was, having experienced a financial crisis firsthand, he would be better equipped to avoid such pitfalls in the future. Lastly, the CEO had built strong relationships in the industry. His network of contacts was seen as an asset that could help the rival company forge new partnerships and open new markets. So despite leading his previous company into a financial crisis, the CEO was seen as a valuable asset by his new employer. His past failures, paradoxically, seem to make him an even more attractive candidate for the job. Here again, we see a CEO failing upwards, despite the apparent setbacks. Now, you might be wondering, why does this happen? What are the underlying reasons? Well, let's dive into it. The first factor to consider here is networking. In the corporate sphere, it is often said that it's not what you know, but who you know. CEOs, due to their high-level positions, are inherently connected with influential figures in the industry. They attend conferences, business meetings, and social events, where they build relationships with other top-tier executives. These connections can open up opportunities and provide a safety net, even when their performance is less than stellar. Moving on, personal branding is another key factor. CEOs are often seen as the face of their companies. They're in the spotlight, giving interviews, making public appearances, and sometimes even becoming household names. This high visibility helps them build a strong personal brand. Even if their company doesn't perform well under their leadership, their personal brand can remain untarnished. They're seen as leaders, innovators, or visionaries, and this perception can help them land on their feet in another high-profile position. Last but not least, let's discuss experience. Companies tend to favor experienced individuals when hiring for top positions. A CEO, despite a failed tenure, still has a wealth of experience under their belt. They've been in the trenches, they've made tough decisions, and they've navigated the complex corporate world. This experience is valuable, and companies often prioritize it over the results of their previous tenure. After all, failure can also be a great teacher, and these CEOs may have learned valuable lessons from their mistakes. So why do CEOs always seem to fail upwards? It's a complex interplay of networking, personal branding, and experience. These factors provide a cushion, allowing them to bounce back even when things don't go as planned. So it seems like a combination of networking, personal branding, and experience plays a significant role in this phenomenon. While this might seem like a win-win situation for the CEOs, there are hidden consequences to this trend. Let's take a deeper dive into the undercurrents of this phenomenon. On the surface, the upward failure of CEOs may appear to be a harmless, even beneficial cycle. But like a riptide, it has the potential to pull companies and employees into a dangerous current of complacency and lack of accountability. Imagine a scenario where a CEO, having been promoted despite a track record of failure, continues to make poor decisions, secure in the knowledge that no matter the outcome, they'll land on their feet. This not only sets a poor example for the rest of the organization, but it also breeds a culture of complacency. Why strive for excellence when mediocrity is rewarded? Furthermore, this trend can lead to a significant erosion of trust within the company. When employees see their leaders failing upwards, it can create a sense of disillusionment and cynicism. They may start to question the fairness of the system, leading to a decrease in morale and productivity. The belief in meritocracy, the very backbone of a thriving corporate culture, begins to crumble. But it's not just the employees who suffer. The companies themselves can face serious repercussions. A CEO who fails upwards can cause a company to stagnate or even regress. The lack of accountability at the top can lead to a lack of innovation and growth at all levels. The company may find itself struggling to keep up with competitors, losing market share and profitability. And what about the investors? They put their faith and money into these companies, expecting them to be steered by competent and accountable leaders. When CEOs fail upwards, it can lead to financial losses and a tarnished reputation for the company. So while failing upwards might seem like a boon for some, it can have far-reaching implications for the corporate world. So there we have it, a glimpse into the intriguing world of CEOs failing upwards. We've taken a deep dive into the lives of tech titans and automobile moguls, unearthing the curious trend of leaders seemingly rewarded for failure. It's a phenomenon that's far from isolated, with roots deeply embedded in the corporate world. From the cushioning effect of established reputations to the complex dynamics of risk and reward, we've explored the various reasons that drive this trend. We've also shed light on the hidden consequences of this phenomenon. While it might seem counterintuitive, the upward trajectory of seemingly failing CEOs can have implications for innovation and growth. It's a reminder that failure isn't always the end. Sometimes it's a stepping stone to bigger and better things. The next time you hear about a CEO landing a better job after a string of failures, you'll know exactly why. Here's to a clearer understanding of the corporate world's eccentricities.